Do you want to expedite your journey to home ownership? Or how about expediting your journey toward business success if you are the entrepreneurial type who wants to grow the next 9-figure or trillion-dollar business? Well, I'm going to tell you one thing that is literally tripping up so many people and costing them more money than what it's actually helping them to make. And so we're going to dig right on into it, and we're going to talk about all of the things that our people are losing out on when it comes to buying homes, when it comes to buying investment properties, when it comes to starting businesses. This is the one thing that people fail to focus on, and it tends to cost them the most money when it comes to starting that business, or when it comes to buying that dream home or buying that investment property that's going to yield you the type of return that's going to support the lifestyle that you want to live. Interest rates, when it comes to purchasing a home, is something that's very, very important. And that's not what I'm talking about, but this is something that it hugely affects. So when you go to purchase a home, everyone focuses on the interest rate because the interest rate is what dictates your monthly payment. However, your credit score, which is the thing that we are going to be talking about, is what dictates the interest rate that you're going to get. Now, your interest rate can be a range of different things depending upon the economy that we're currently living in and a bunch of other factors. However, your credit score is going to dictate the interest rate that you get, which is ultimately going to determine whether or not you are paying hundreds of dollars more per month for that mortgage payment, or whether you're paying thousands of dollars more per year for that mortgage payment. And so that's the first thing. The credit score that you have will determine the interest rate that you can get. And it can literally make the difference between a 1 or 1.5% difference in an interest rate, or more in some cases. And so not only does it determine the interest rate that you get, it determines how much you pay for that interest rate. There's this thing called a discount point. A lot of people don't know what it means. It's really a mortgage term, but what it means is that's the actual amount that you're paying for the interest rate that you get. So when a lender tells you that they can give you a 5% interest rate or a 6% interest rate, there may be a cost associated with that. So if you have a high credit score, maybe you're able to get that 5% interest rate and it doesn't cost you anything. But if you have a lower credit score, then that same 5% interest rate might cost you $3,000 to get, whereas the person with the great credit score didn't have to pay anything. It's costing you thousands of dollars to get that same interest rate. Now, if you wanted an interest rate that doesn't cost you anything, that might end up increasing your interest rate to where now maybe you get a 6% interest rate or a 6.5% interest rate that doesn't cost you anything. But for you to get that 5% interest rate, it might cost you a lot more money, and it might be more than $3,000. I've seen instances where it costs $11,000 or $12,000 for you to get the same interest rate as someone else who could get it much cheaper because they have better credit. So that's what it's determining on your discount points, or how much you're actually paying for that interest rate. You're going to have to put up more money to get the same thing as someone who has a better credit can get for less money. So that's another thing as well. Also, your credit score determines how much you can actually get approved for, because it factors into your debt to income ratio. So your debt to income ratio determines how much home you can qualify to purchase. Let's say, for example, that a lender is going to use 50% of your income to qualify you for a mortgage. Well, if you've got great credit, they can use 50% of your income. But if you've got subpar credit, maybe they can only use 40% of your income or 30%. And so now you can only use a smaller portion of your income to qualify you for that home that you're wanting, meaning that you don't qualify for as much, because rather than, let's say if your income is $8,000 a month and half of that is $4,000 a month, but if they can only use 40% of that, that's even less, which means you don't qualify for as much home. Whereas if you had better credit, they could qualify you for a higher amount because you can utilize more of your income to qualify for that home. So that's another thing. Your credit affects the interest rate that you get, which literally can make hundreds of dollars a month difference in your monthly payment. It also affects how much you pay for that interest rate up front. That's money that has to be paid when you close on the home. And that can be thousands of dollars of difference up front in how much you have to pay because of your interest rate. But that credit score also affects your homeowner's insurance, Oh, and I mentioned also it affects your debt to income ratio with how much you have to actually pay for or how much you can actually qualify for that home. But it also affects your homeowner's insurance. Your homeowner's insurance is dictated in part by your credit score. I was actually speaking with a homeowner's insurance agent today and was asking them questions about, hey, so when you're going to approve people for homes, I know, or approve people for insurance policies, I know that you're looking at how long the roof has been on the house, what condition is the roof in, what's the age of the house. I know you're looking at all these things with the house, but do you also pull credit? And the response was, yes, we do pull credit. I already knew the answer because I've spoken with a lot of different insurance agents before, but it's always nice to ask the questions of each individual insurance agent because they have different policies and sometimes those policies change. But the response was, yes, we do a credit pull to see what their credit is like. And if their credit is bad enough, there are some companies that won't insure you, meaning that you could be purchasing a house and you might be thinking, oh, they're insuring the house. No, they're insuring the house according to your ability to actually pay, because it makes no sense for them to insure a house when you're not going to be making your mortgage payments, because then they're not going to be getting paid because the money that the insurance company gets comes out of your mortgage payments. So if you're the type of person that has bad credit and you don't pay your mortgage on time, then they're also going to be looking at that. They also look at things such as the claims that have been filed on the house or claims that you filed previously in the past before. So that also plays a factor. But your credit score, the big topic of tonight, is the one thing that they are looking at or one of the many things they're looking at to determine whether or not to even give you an insurance policy for that home that you're looking to purchase. So by having a higher credit score, not only are you opening yourself up to more possibilities in terms of insurance agents that want to work with you and want your business and want to insure the home that you're purchasing, you're also opening yourself up to lower premiums that you're going to have to pay. So your premiums, that monthly amount that you pay for your homeowner's insurance from month to month to month. Now, if you have a lower insurance policy, that means that your premiums that you're paying, or if you have a higher credit score, that means that the premium that you pay can be lower. So you're not paying as much as someone who has a lower credit score. So you could save hundreds of dollars in a month. You could save thousands of dollars in a year, literally by working on your credit score. You might be like, oh, it's not really hundreds of dollars a month, is it? Yes, it literally can be, because the difference between you being able to get with an insurance company that will give you a great rate and you having to go with an insurance company that finances or that will insure people that have bad credit, that insurance company that's insuring people that have bad credit is charging you for that because you're a higher risk. And so now they're charging you more money in your premium versus you probably could have saved hundreds of dollars literally every single month by going with another insurance company, or thousands of dollars in a year by going with another insurance company that can literally give you those lower premiums and has more options available to you as well. So working on that credit score can do a lot in terms of interest rates, how much you pay, the interest rate that you get, what your debt to income ratio is, meaning how much home you can actually qualify for, but also what you pay in homeowners insurance. But let's get outside of just the home that you're looking to buy for yourself to live in, because a bigger and I think equally important thing is the purpose that a lot of people feel that they are called to fulfill, which is business. There are so many people out there that just have a desire to start their own business, and they want to get into the marketplace. They want to serve people at the highest level, doing things that they love doing. And that takes money. And a lot of people don't have the cash or the ability to be able to bootstrap a business. Maybe the business that you're going into is going to require some capital to get started. And maybe you don't have angel investors or people that can just give you large sums of money to get your business off the ground. So you might have to tap into business funding. But guess what? Business funding works on a different scale separate from your personal credit. There's a whole nother thing called business credit. But guess what? A lot of people get started and build business credit utilizing their personal credit, because a lot of times, especially when you're first getting started out in business, before you build that sustainable business, a lot of times they'll want you to personal guarantee or have a personal guarantee with the money that they're giving you for your business. What that means is that if a bank or a lender is going to give you a business loan, even though it's a business loan, a lot of times they'll want you to have a personal guarantee, meaning that, hey, if your business fails, you're personally going to guarantee that you're going to pay back this money. Now, a lot of times you don't have an option to even get the business funding or get started building your business credit if you don't have good personal credit, because to start building business credit, a lot of people utilize their personal credit as that personal guarantee that, hey, help me start building my business credit because look, I've got great personal credit. I'm good with managing money. I'm good with paying debt back on time and managing debt well and utilizing it to my benefit and everything, and to the benefit of those who are lending it to you. So if you have that good personal credit, that helps you get a stepping stone to thereby build business credit and get business funding so that you can fund what you want in those business opportunities, whether it be starting, a contracting company, a landscaping company, plumbing company. Maybe you want to start a software company and you're developing new software, or you want to start a hair salon. Whatever it is, you can access the funding that ends up being the piece that causes a lot of businesses to fail. A lot of businesses don't have the funding that's needed up front to get their businesses to the point to where they can now be self-sustaining. If you look at a lot of the businesses that are out there, you look at a lot of the companies that are in Fortune 500s. It's funny how a lot of those companies at one point were on the verge of not making it. Some of them were on the verge of bankruptcy, but they had investors that were willing to invest in them to keep them afloat, and having that money, even just enough to carry them for an extra couple of months to reach that breaking point to where now that business was not only able to be self-sustaining, it was able to launch off into the stratosphere to become a world leader in whatever area that they're in. That's the type of opportunity that you can get by getting business funding, but that's also the type of opportunity that you can have available to you, starting with building your personal credit, having good personal credit. That's something that's really going to be the key for you. So whether it's purchasing a home, whether it's getting an interest rate, whether it's purchasing an investment property, whether it's starting your business, the foundation for all of it is your personal credit. I started off this broadcast by saying, if you wanted to expedite your journey to home ownership, if you wanted to expedite your journey toward the business that you desire to work in for the next several decades, if you want to expedite your journey anywhere along those paths, it's going to be key that you focus on your personal credit. That is going to be the foundation for you being able to save hundreds and thousands and tens of thousands of dollars and even hundreds of thousands of dollars. Now, why would I say hundreds of thousands of dollars? Because not being able to take those steps is going to cost you money. For example, if you could purchase a home today that's going to continue to appreciate at 4% year over year for the next decade, depending upon the price of that home, that could be tens of thousands of dollars in your pocket. Or if you wanted to start a business where you get into purchasing real estate, fixing it up, and then putting it out on the market as a long-term rental, but you're not able to take care of that, or you're not able to take advantage of that opportunity because you lack the personal credit to start building the business credit, to get the business funding, to get that idea off the ground, then what is that opportunity costing you? Maybe it's costing you hundreds of thousands of dollars because now you're not able to capitalize on a 50 or 100 or 150 or $200,000 opportunity and turn it into a 400, a 600, a thousand, 800,000, $1 million opportunity. You're not able to capitalize on those smaller opportunities and turn them into bigger opportunities because your credit is bad and no one wants to take a chance on you. No banks, no lenders want to take a chance on you when your credit is in the dumps. So by working on your personal credit, that's going to open up all of the doors to allow you to purchase your dream home, to allow you to purchase investment property that's going to support the lifestyle you want to live. That's going to open up the doors to allow you to get the business funding that's going to allow you to start and grow and build the business of your dreams, the thing that you're passionate about doing, the purpose that you feel called to fulfill. Having that foundation of great credit is what's going to start elevating you to that level that you really want to be operating at. Focus on the personal credit. And with that, I'll wrap up by saying, if you do need assistance with your personal credit, I'm going to actually drop some links below in the description, because there are some options that you have where you can get started today working on that personal credit. And literally 3 months from now, 6 months from now, 9 months from now, you could be in a position where you can now start taking advantage of the opportunities with starting that dream business, or buying that dream home, or buying that investment property and having someone else put money in your pocket and pay the mortgage on that property, which is growing in equity, which is adding to your net worth as well. So check the links below. There are a couple of different programs actually that are out there, but one of the ones that I'm going to highlight is literally a full service program, because everybody's time is tight right now. A lot of people have really busy schedules. And so one of the programs that I'm going to highlight below in the description rather is for a credit repair program where literally the work is done for you. You just need to do your part essentially, which is meeting with the individuals that are helping you to repair your credit and get this journey on the road so that you can get on to better credit and the other things that you want to accomplish in life. So that's what I have for you in this episode. Wanted to highlight the importance of credit and how costly it will be if you don't work on fixing and improving your personal credit. So that's what I have for you. Thank you for taking the time to tune in. Take care, be blessed, and we'll see you next Tuesday.